All right, everybody, welcome to today's live session. Good to have you guys back here today. It's a new month, it's February. Welcome to the new month. The new month comes with fresh charts, fresh market movements, and it should also come with a fresh mindset for you. Now, before we even talk about the charts and why we're here today, I want to ask you guys a question. I want to ask you guys something. Yeah, let me know in the chat. How did January treat you? How was trading in January? What was it like? Did you trade well? Did you rush entries? Did you learn something? Let me know in the chat. Did you chase candles as well? You can also let me know in the chat if it was a roller coaster month for you as well. And guys, be honest with yourself because trading is not about, pretending that you're profitable. It's about improving month by month. Okay, so let me know in the chat. How was trading in January for you? If you're just joining, welcome to the live session. Good evening, Lucy from Nairobi, Kenya. Welcome to the session. Now, while you guys are going on to answer that question, I'm going to go through the disclaimer and also run through a brief introduction of myself. Any opinion, news, research, prices, analysis, or other information discussed in this webinar or linked to this presentation is provided as general market commentary and does not constitute investment advice. Now, for those of you that do not know who I am, my name is Ambrose Ebuka. I have 6 years of trading experience and I've built a style that blends precision swing trading with strategic scalp trading. I mostly trade and analyze gold, GBP, JPY, and I maintain over 85% accuracy that is backed by discipline and non-stop back testing. All right, if you're just joining, once again, welcome to the session. Let me know in the chat, guys. How was trading in January for you? And if you're new to the channel, you can go ahead and hit the subscribe button. You can also share this live to your friends so that they can also learn about the financial markets. It's very important as well that as you learn, you're also learning with friends as well. And if you notice, there's a slow mode. The slow mode is turned on, so you'll be able to send messages after 20 seconds. Okay, and for you to be able to send a message, you have to be subscribed to the channel. The subscriber only mode is turned on. I think you can see it in the chat. It says messages that appear are from people who have subscribed to this channel for 1 minute or longer. So when you subscribe, just wait for 1 minute at least, and then you can be able to send a message. And when you send a message, you can only send another message after 20 seconds. Lucy says January was a profitable month. Amazing. It's good to see that you had an amazing and a profitable January. I'm waiting to see other comments anyway. Or you can let me know what is one habit, you know, that you want to fix in February. What's one thing? It can be over trading, it can be risk management, it can be patience, it can be confidence. I want to see in the chat, guys. What's one thing you're looking forward to fixing in February? You see, the idea of participating in sessions like this and also um, doing self learning or conducting self learning is because you want to understand the market so you can stop feeling lost when price moves because the prices move wildly. I mean, late January last week, it showed us that the market can flip fast. Now, if you've not traded gold before, at least from December up until now, you would see how wild the markets can move. The dollar dropped late January. Gold blew up late January, and then both of them shifted. So now the dollar is beginning to gain strength, and gold is dropping. And if you did not understand why, you know, you might think it's a random thing that happens in the market. You come to the market and you hear that, oh, the price is gold is volatile, this and that. It wasn't random. And today we're going to break that down in simple terms. We're going to talk about the economic calendar as well, so that in February, we're already 5 days into February, but you don't want trading this month to, you don't want to trade off guard this month. Okay, so by the end of this session and by the end of this live stream or YouTube video, just in case you're watching after the stream, you would understand and you'd have a calm and clear and more confident understanding of the financial markets than when you just joined. All right, let's see if we have some more comments in the chat before we get started. Live stream. All right, guys. Okay, so today we are going to be looking at the economic calendar first. You guys know I always like to check the economic calendar to know what's going on in the markets and also to help you guys understand what's going on in the markets because I usually already check it, right? But when I come to this stream, I have to break it down for you so you can understand as well and so that it can become more like a habit for you. When you wake up, when you're about to start trading, you have to check the economic calendar, see what's moving these prices, and just be aware of any future event that'll be happening for the day, for the week, for the month. All right, DXY review. I mean, when I mean for the month, you guys know NFP is around the corner. DXY, which is the dollar index, we're going to look at that, and also correlation with other pairs as well, like gold, GBP USD, Euro USD. You guys can also go ahead and comment in the chat. What pairs you want me to analyze for you. I would have a Q&A session where you can ask me questions, and I can also ask you questions based on how I'm feeling. But the session is going to last for about 45 minutes. You can use the YouTube live chat to ask your questions during this session. I'm constantly checking to, see if you guys have any questions, and I would answer them all. Before we get into strategy, yeah, we're going to look at the economic calendar. And after the economic calendar, we'll come back to strategy. And you guys know the strategy that I use is zone trading strategy. Pretty simple, nothing too complex, very simple to understand. But I'll come back to this and we would explain it, right? But let's go to the economic calendar. How many of you guys have used the economic calendar before? If you've used the economic calendar before, let me know in the chat. You can go ahead and say I have. If you've used the economic calendar before, you can go ahead and say I have in the chat. Let's see if we have people that have used the economic calendar. All right. So if you don't know, the economic calendar is basically a schedule of events that tell traders what governments, what central banks are doing, how healthy the economy is, the things that might move currencies. Guys, you have to understand. And I think when you understand this, your idea of trading, the initial mindsets you had or the initial psychology you had about trading would begin to change. Currencies don't move randomly. They don't. They move because of interest rates, inflation, spending, central bank decisions, trade, um, geopolitical events, expectations about the future. Every single event that you see on the calendar gives you a clue about one of these things I just mentioned. So if you've not been using it before, it's important that you start using the economic calendar. This is the Octa economic calendar, very detailed. If you're new to this, I'll still show you how to go through it and navigate through the economic calendar. But the calendar is basically just see it as the brain behind market movement. All right. And another thing that I want you guys to understand, and this is just for people that are probably watching this stream for the first time or are in the early stages of trading, you have to understand that there's something called a central bank. They have the real power. The central bank is, I mean, you guys are familiar with the CBN, yeah? So it's basically the institution that controls the interest rates, the supply of money, the inflation policies that you see, financial stability. And just like we have CBN, each central bank here, or each currency has a central bank. Like the AUD has the Reserve Bank of Australia. The Euro has ECB. Sorry, guys. Gotta put that out. All right. The GBP, we're back, guys. So the GBP, the Bank of England, right? The Bank of England is the central bank that, well, it's for England, and then the currency is obviously the British pounds. And then we have, it's not here, but okay, it's right here, CAD, which is the Bank of Canada. Now, there is New Zealand, the Reserve Bank of New Zealand. There's still other currencies that would also have the central banks for that country, right? Now, here's what I want you guys to understand about the central banks. They're basically the boss. If a central bank changes the interest rates, the markets would react immediately because interest rates generally affect borrowing, it affects spending, it affects investing, it affects currency demand. These are all the things that the interest rates affect. And when the interest rates are high, the currency becomes the demand for the currency becomes high. When the interest rates are low, the demand for the currency becomes low, and it leads to a weak currency. So if you're ready to watch me go over this event one by one, let me know in the chat. You can go ahead and type "I'm ready" in the chat, and we'll go about this event one by one. Guys, it's very important that you understand exactly how to use the economic calendar and also how to read the news, just because it can put you 5 steps, in front before the peeps even start coming in. Just by understanding the decisions that are going to be made and how long these decisions would impact the currency can keep you you can be in a trade for 50 pips, but because you understand how long a central bank decision would affect the currency, that would even keep you in that trade for over 500, 600 pips into the future, and you get to make more profit. So if you're ready, go ahead and type "I'm ready" in the chat, guys. All right, so we're going to start with the AUD trade balance. AUD trade balance. And when you see MOM, what it means is month over month. Now, the AUD or the trade balance generally, just in case it sits for another country or currency, it measures the exports minus imports. So if Australia exports more than it imports, then it's the positive trade balance. If you're exporting more than you're importing, if you're selling out more than you're buying, it's positive for the country or for the currency. A lot of foreigners would buy your domestic currency to pay for goods. If you want to buy, let's say you want to buy clothes from an American company, yeah, you'd have to convert your naira to dollar. Most of the times, you just fund a dollar account or you fund your naira card. But guys, I have to tell you, when you're making the payment, your bank automatically converts your naira to the equivalent of the dollar to pay for that goods. And when this happens, it increases the demand for the currency, and the currency gets to grow even more. Now, we're going to use the figures that we have here, the reports that we have here to analyze this. Now, guys, we're going to get to the technical aspect of today's session, but this is the fundamentals, and it's important that you pay attention to this so you can understand it once and for all. And you can always come back to this video to rewatch and even understand better if you have any difficulties understanding. But this is an important part of trading fundamentals. Just in case you guys are eager to go into gold and see what's happening right now, guys, don't worry. There are new opportunities every day in the markets, and we're going to obviously get to that. All right. Now, the previous number was 2.936, which is 2.9 billion Australian dollars. It was forecasted to increase, obviously, to 3.3. And now we're seeing that the increment was true. The actual came out at 3.373, which is even better than what was expected. And what does this mean? It means that Australia exported more than even what the analysts predicted, which means foreign demand for Australian goods were increased. Buyers needed to pay Australian dollars for their exports, the currency, the Australian currency, the demand for Australian currency increased, which is the Australian dollar. So Australia ended up selling more than what we thought it would. They ended up exporting rather. So if I say selling, so you don't think that the market sold. No. They exported. When you're exporting, you're selling. Yeah. They exported more than what the analysts thought. And it's a positive signal for um, you as a trader, a positive signal for the analysts and investors as well. This is good for the Australian dollar. It even improved drastically from the previous amount at 2.93. This is a very good increment. It shows you that momentum is rising rather. It shows you that the trade is getting strong. It shows you that the economy is even healthy. Okay, so this is good for the Australian dollar. Then we have the euro retail sales year over year. When you see YOY, it means year over year. It gives you the report of what's going on this month as compared to the same time last month. So last year, right? The same month last year. Okay, so I'll give you guys an example. Don't worry. Previous 2.3. What it tells you is that at this time last year, the report was 2.3. This is for December. Yeah. So by December a year ago, for the report for December a year ago, the report came out at 2.3, and currently it's at 1.3. But first, what is the euro retail sales? The euro retail sales measures consumer spending growth in the Eurozone or in Europe. Let me know if you guys understood that. It measures consumer spending growth in Europe, or you can say the Eurozone. If the consumers are spending more, it leads to strong economy, a possible increase in interest rates, inflation pressure, bullish currency. If the consumers are spending less, economic slowdown would be expected. It would also lead to a weak demand in the currency. The central bank would end up being dovish, and it would lead to bearish currencies. So in simple terms, the retail sales just shows you the health of everyday people, like how are they spending. If people stop spending, then the risk for a recession would increase, and this is what the central bank watches closely. So the previous was at 2.3, the actual 1.3, the forecast was at 1.6, which means, the analysts expected it to come out lower than before, but it came out even lower than what the analysts expected. So this came out weaker than expected. And what it means is that the consumers are spending less than what the analysts predicted. Remember, guys, if the spending slows, if the spending is reduced, businesses would not earn a lot of money. There will be weak growth or no growth at all. There will be inflationary pressures. Drops down, reduced. The central bank may become even cautious. If you look at 2.3 as previous to the current 1.3, it tells you that this is a clear slowdown. And what this means is that the European economy is cooling down. When the European economy cools down, remember the central bank pays attention to this. So the ECB would be paying attention to this, and they'll be under pressure to increase the interest rate aggressively at this point. But this report came out low, and it is bearish for the euro. Now, if you want to understand by yourself the definition of each economic event, you can always click on it, and Octa gives a very simplified explanation for these events, what they mean, and exactly how you can trade the impact. So, for example, if you look here, you'd see a high reading is seen as bullish for the euro, while a low reading is seen as bearish. So, obviously, you know that this came out low, so it's bearish for the euro. Let me know in the chat, guys. Let me know in the chat if you're understanding. And if you also have any questions as well, you can go ahead and always ask your questions in the chat, guys. All right. I'm just checking the live chat to see if you guys have any questions for me. Okay, no questions. Okay, so we're going to go straight to the BOE for those of you that are already familiar with Bank of England. So we're going to call it BOE, right? If you see it somewhere, you know that it's the Bank of England. The BOE interest rate decision. So what is this? This is the main rate controlled by the Bank of England. This rate affects, let's see, this rate affects the mortgage or the mortgages, the loans, business borrowing, consumer spending. So if the BOE increases the interest rates, the GBP usually strengthens. If the BOE cuts the rate, the GBP usually weakens. But I want you guys to remember something. The market reacts to surprises. If traders expect the market, or if traders expected an increase or a rate hike, and it happens, GBP may not even move so much. But if the expectations are wrong, then you'll see like a wild reaction to the market. So what I'm trying to tell you guys is that expectations drive markets more than numbers. If you expect, as you guys can see already, previous 3.75, forecast 3.75, it came out to be 3.75. So if you expect, oh, when I wake up tomorrow morning, the dollar is going to be trading at 1,500 naira for $1, and then you wake up and it's trading at $1,500 or 500 naira for $1, you will not be surprised. But when you wake up and you're seeing the dollar is trading at 1 naira to $1, I mean, I think you guys are going to start using all your money to buy the dollar, right? To just, buy and save and, react. That's what I mean by expectations drive markets more than numbers. The next thing we have is again, I think we're done with the interest rate decisions. The next thing we have is the monetary policy summary, the reports, the minutes, all these things. These are just basically documents that show the discussions that happened internally, economic projections, inflation expectations, all these things. It's like the diary of the central bank. So if you're ever going to focus on these things, some of the things that you should be looking for are if they're worried about inflation, if they're worried about recession, if they're planning future rate hikes, all these things are the things that shape long-term currency direction. If you understand what they want to do and how they want to react to inflation, pressure, recession, rate hikes, it can help you understand how long a currency is going to trend in a particular direction. We're going to look at the Bank of England MPC vote rate. Now, before I even talk about this, MPC, it means Monetary Policy Committee. So it basically shows you how many policymakers voted for the rate to be unchanged, which means for there to be no change, the rate to be cut, or the rate to be increased. I'll give an example. You can see that nobody voted for an increase. 4 people voted for the rate to be cut. 5 people voted for the rate to remain the same. Right? If you look at this unchanged, MPC votes rate unchanged, it tells you that about 5 people, there are a lot of policymakers that voted for the rate to be unchanged. 5 people voted for it to be unchanged. You can also go ahead and click on this, and then again, you can read, understand exactly what it means. For rate cut, this is also a very important report. As you can see, the forecast was for 2 people to vote for the rate to be cut, but 4 people actually voted. Now, when you're looking at the monetary policy report and just this rate cuts and the rate hikes, you necessarily need to pay attention to the forecast and the actual, not really the previous. In previous times, 5 people voted for a rate cut. The market expected only 2 people to vote for a rate cut, but now we're seeing that 2 extra persons even voted. Let me go back to the unchanged. The market expected 7 people to vote for it to remain the same, but the people that voted for it to remain the same were lesser than what we expected. So you can see that more people voted for the rate to be cut than expected. So it tells you that, there's an increase in economic concerns and rate cuts may be coming in the future. Then for the rate hike, obviously nobody wants the interest rates to be increased. And when you see things like this, it just tells you that tightening is done. The Bank of England is not thinking about increasing the interest rates anymore. They are basically just debating, or should we leave it the same way? Should we cut it? I hope you guys understand this. I hope you guys understand this. It's very important, guys. Very, very, very important. You can just read through this to understand what it means. The main refinancing operations rate is the main interest rate in Europe. Is the rate that the commercial banks pay to borrow money from the European Central Bank. Okay, then we have the rate on deposit facility. This rate is basically what the banks earn for storing money overnight with the European Central Bank. Okay, just think of it like a saving account for banks. If the European Central Bank increases the rate, then banks will prefer to save than to lend. And when the banks prefer to save with the ECB than to lend, there will be less money in circulation, and the economy will be tight a bit, but the currency would strengthen. And then we have the monetary policy statement. This is basically the explanation. So after announcing the interest rates, the European Central Bank will just release a written statement that explains, why they made the decision, the outlook, the inflation outlook, economic risk, future plans. And as a trader, you want to focus on the words, the wording. One sentence can change what you expect from the market. One sentence can tell you when or if there will be more rate hikes ahead. And then we have the press conference, which is where most of the officials from the European Central Bank will speak live and answer questions. Also important to pay attention to this because you want to look at their tone. Are they hawkish? Are they dovish? Just pay attention like you're a detective, okay? And then we have all these speeches coming up, which is also important and powerful because most of these speeches are unscripted. So the governors would probably hint at future rate hikes, concerns from inflationary pressures, any shifts that they're going to have in policies, and the markets react instantly to these things. So if they're confident, if they show a confident tone, it can lead to a bullish move. If they show a worried or so concerned tone, it can lead to a bearish move as well. Now, if you're a beginner trader and you're starting to get familiar with the economic calendar, I'm going to give you guys some tips on how you can actually use this. So don't focus on memorizing the numbers. Ask yourself some important questions. Is the inflation going up? What is the tone of the central bank? Are consumers spending? All these questions are the kind of questions that would explain the movement in price. So that you don't come into the market and you start guessing. Trading is basically you interpreting economic behavior. Let me know in the chat if you guys understood that analysis. We're going to go straight into the technical aspect of today's session. Let me know in the chat if you guys understood the economical analysis. If you have questions, please ask your questions in the chat as well. All right. No questions. I'm going to assume that everybody understood the analysis. We're going to go straight into the technicals. All right. So we're going to start with the dollar index. You guys know I always look at the dollar index to see what's going on with the markets. And we're going to talk about what happened in the markets because late January, from here, the last week of January into early February, basically gave us a perfect real life lesson in how money actually moves in this market. And if you're a beginner, it's very important to understand because these markets don't move just because a lot of numbers come out. They move because of confidence, expectations, and how people feel about the future. And the best way to see that is through the relationship between the dollar and gold. Now, the first thing you need to know is that the dollar and gold are like opposite modes. When the investors feel confident about the financial system, they hold the dollars. When they feel nervous, when they feel unsure, they start moving their money into gold. Gold is like financial safety. The dollar is like financial power. So when the confidence shifts, the money is going to shift as well. And that's the foundation of everything that we're going to be talking about in today's session. Now, if you look at what happened with the dollar, late January, from mid to late January, the dollar started dropping pretty hard. Not necessarily crashing, but weakening a lot, especially towards the end of January. And a lot of you guys normally ask the question, why is the dollar dropping? Why is it dropping? I don't know if you guys actually go on to find the answers to that or you just ask because you're curious. But in case you're looking for the answers, it was a mix of, uncertainty around US policies, concerns about economic direction, and some political noise that made investors uncomfortable. Now, here's the thing I want you guys to understand, especially beginner traders. Money does not like uncertainty. Investors don't like guessing. They like stability. So if there is doubt about the future direction of the economy or the central bank, people will start reducing exposure to that currency. It's basically risk management, if you want to put it in a general term. So it's just like they're saying, I'm not sure of what's coming next, so I'm just going to take out my money. I'm going to step back, and that's take out my money and invest somewhere else. That I'm going to step back weakens the dollar. But at the same time, fear and uncertainty, it doesn't just make the money disappear. When they step back and take out their money, what happens? It relocates. And where does this money go? To gold. You guys already know that gold is like the ancient backup system of finance. It doesn't depend on the government. It doesn't depend on interest rates the same way that currencies do. So when confidence drops in these currencies, gold becomes attractive. And that's why if you look at the gold market, it didn't just rise, in late January. It exploded. Boom. And started creating and making record highs. People are not just buying gold because it's gold, it's good. They were buying because it felt safer than holding dollars due to or during the time of uncertainty. And when gold start breaking all these records, boom, 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 what happens? Momentum kicks in. A lot of traders will begin to jump in because they don't want to miss the move. What does that do? It creates this massive wave of buying pressure on top of the already existing fear and demand that is already existing. And that's how you get a surge. But this is the part I want you guys to remember always. The markets don't move in straight lines forever. There is nothing in this market that goes up endlessly. Right? You can see there's nothing that goes up endlessly. If there's an impulsive move or a rally to the top side, it gets a bit crowded at the top and the conditions get set in for a pullback. And that's exactly what happened with gold. After gold hit all these highs, expectations began to shift. The conversation moved, to the idea that the US monetary policy might even stay stricter for a long period of time. People started to feel like, oh, maybe the Federal Reserve is not going to soft anytime soon. Maybe they're not going to get soft. And when investors think that the rates may stay higher or the policy may remain tight, then the dollar will become attractive again. Higher rates mean better returns on the dollar assets. And when there's better returns, it pulls money back into the currency. So the dollar started recovering. And whenever the dollar begins to find strength, gold usually loses support. I'm going to write this down. Gold and the dollar, I'll put this up here. Gold and the dollar always compete for safety of money. You guys should keep this in mind. Now, at the same time, the traders that bought gold early started doing what professionals would always do. You can let me know in the chat what happens when you buy early, when you buy from here to here. What do you do? Let me know in the chat. What happens when you buy early and you see the market rally up over 2,000 pips, even 5,000 pips? They take profits. You take profits. That was a huge move. I'm going to lock in my profits. When you take profit, you're not panicking. It's discipline. When you take huge profits like this. But what happens when a lot of people do it at once? Then it becomes, or it starts to look like what? A sell-off. So this drop was a combination of different things. Change of expectations, money moving back into the dollars, and a lot of traders cashing out after a huge profit in the market. And this is natural in the market. It's a natural market cycle. It's basically rotation. Money goes from supply to demand and back to supply and back to demand. And that's the lesson I want you guys to work with. That's the lesson I want you guys to take out of this market. The market is like an emotional ecosystem. It breathes. Fear, buy, sell, supply, demand. Uncertainty and fear would push investors' money into gold. Confidence will pull the money back into currency. That is just it. Every move you see in this market, every single candlestick, and every major move is basically a reaction to how investors and traders feel about the future. And if you understand that flow, then the charts begin to make a lot of sense. You stop chasing every single candlestick. You start to read the behavior. And then you see that you stop guessing in the market. You begin to interpret movements in these markets. Let me know in the chat if you guys understood. So what are we looking out for in February? Well, I'm going to give you guys my own analysis and what I expect. I expect gold to trade within these zones. I'm not really expecting a big trend or a crash. I just expect gold to trade within these highs and the lows for at least the first 2 to 3 weeks in February. Late January was a bit emotional, and then early February. So I believe the market is going to calm down and figure out the next thing it's going to do. If you look at the dollar market, you can see that it's starting to stabilize after the drop. If the US economic data stays strong, then the dollar would slowly gain some strength and come up to trade in these zones. Not really like an explosion, but just a steady recovery to the upside. But if the data weakens or traders start expecting rate cuts again, then the dollar could slip down to make a retest here and even further to the downside. So for the dollar, February is basically about reaction to the news, you know, inflation numbers, speech from the Federal Reserve, All these things would matter even more than usual. So that's my analysis and expectation for the dollar in February. For gold, let's go back to gold. And guys, you can use the analysis for the dollar to also look at GBP USD as well and Euro USD. All right, they move in opposite directions mostly. So gold just came down from what I would call a record move. Gold has never been at this point before. For the first time, almost hitting 600 dollars per ounce. Now, after huge moves like this, the market usually cools down. So what I expect from gold is a sideways movement, or even for the market to drift lower for another retest here. And it's normal when it does that. It's normal. It doesn't mean that, oh, the bullish one is done, gold is broken. It basically means that the market needs to breathe. Even if you're running a marathon, 800 meters, at some point you stop and you breathe. But you don't necessarily just stop at a point. You keep moving, but you would breathe, catch your breath, or even turn back and you know. But if there's uncertainty in the market again, you guys know how geopolitical events can be, then gold can quickly bounce again. Gold reacts fast. Gold reacts fast to uncertainty. So February is going to be like a choppy month, in my opinion. Um, a lot of fake moves, a lot of reversals and volatility. So, guys, this is going to be, and it's expected to be a patient month. You know, if you're a good trader, you survive choppy markets, and good traders require a lot of patience. Don't force trades. Uh, Watch the news, watch expectations. Don't go ahead trading every candlestick on NFP day tomorrow. The market is basically going to be deciding its direction in February, and until it decides, a lot of people will be shaken out of this market. So your job in February is not to start predicting every move, is to observe, protect capital, and trade accordingly. That's how beginners, grow into professionals. All right. So guys, this is the Q&A section of today's live stream. If you've got questions for me, you can go ahead and ask me your questions. This is the Q&A session of today's live stream. If you've got questions, please go ahead and ask me your questions. And if you haven't already, you can go ahead and download the Octa trading app. It offers a wide range of trading instruments with low spreads, fast execution, and zero commissions. It also has various educational resources, 24/7 customer support, and a strong commitment to funds and data security. If you made it to this far, congratulations. You have now received a promo code that can give you 100% bonus on your deposit. The promo code is Ambrose E100. Good evening, Paul from Nigeria. Welcome to the session. Now, to take advantage of this promo code, go to the Octa trading app or visit the official site. In the promo code section in the menu of your profile, type in Ambrose E100 and click on activate. You can make your deposit and enjoy your bonus. There will be a required trading volume for you to withdraw your bonus to your bank account or your trading account. So always look out for that. Guys, Q&As. Ask me some questions, guys. And if you're in the chat today, let me know if you have any questions as well. If you don't have any questions, you can go ahead and tell me one thing you understood from today's session. It could be the direction of gold. It could be from economic calendar and analysis. But let me know in the chat, guys. What was one thing you learned from today's session? Because if I don't get questions, I would assume that the session was pretty comprehensive. But at the same time, I want to know if you guys learned, one or two things. Guys, NFP is tomorrow. Non-farm payroll for at 2:30 p.m. Non-farm payrolls. It's gonna be a volatile period. Uh, I actually expect a lot of volatility just because of the whole uncertainty with the markets right now on gold. I expect a lot of volatility tomorrow. So around this time, you've got to be careful if you're in the markets and adjust the positions accordingly. You can see that the analysts are expecting an increase in the amount of jobs, amount of people that are unemployed. So if this number is high, it tells you that it's not it's good for the dollar. If it's low, it's seen as bearish. Let me know if you guys have questions. Okay, Blessing is asking, I'd like to know when to place a trade because I notice sometimes the market will take me to my direction. It will take me hours before going to my direction. I don't know what I'm doing wrong. All right, cool. So here's the thing: if the market eventually goes to a direction, then it's not a strategy problem. Okay, it's more of an entry problem. So you basically just have an early entry, concern, and one of the ways that you can, curb that would be one, you can use pending orders, or you can, wherever you want to put your stop loss initially, that should now be your entry. You can try that and slowly see over a few couple of days or weeks the improvements, and then you adjust accordingly. Okay, let me know if you got that tip or insight. So the non-farm payroll tells you how many jobs are added to the US. The higher the number, the better for the dollar. The lower the number, the badder for the dollar, if that's a word. Guys, questions, guys. Come on, come on. All right. Let's see. Do we have anyone? Okay. Well, guys, this is gonna be where we get to wrap up the session today. We value your feedback. Please take a moment. It's gonna be just 1 minute to fill out the survey. The link is gonna be in the description and also in the live chat as well. You can scan the QR code to also get the link to give us a feedback on the stream, the live stream for today. Guys, we're done with the stream, and I want you guys to, leave the stream with one thing in mind. Your job as a trader is to get better, not faster. So if you learned something today, even if it's small, that's progress. All right. Trading is not about making so much money overnight. It's about stacking small improvements, small gains, small profits until they become consistent. So we're already 5 days into February. Um, go into this month, patient, protect your capital, respect your risk, and trade with understanding in February. Thank you guys for joining the stream, and I'll see you guys in the next one. Bye.